Have you ever wondered why prices for things sometimes seem totally disconnected from reality? Why people get caught up in frenzies, buying things not because of their true value, but because they think the price will just keep going up? That's the world of financial bubbles, and understanding them is crucial, especially in today's market. A financial bubble is essentially a situation where the price of an asset like stocks, real estate, or even, believe it or not, tulips, rises to levels unsustainable by its underlying fundamentals. It's driven by speculation, herd mentality, and often easy credit. Think of it like inflating a balloon. At first, it seems harmless, even exciting. But eventually, it reaches a point where even a small pinprick can cause it to burst, leading to significant financial losses. Let's rewind a few centuries to understand how this all started. One of the earliest and most famous examples, Tulip Mania in 17th century Holland. Yes, tulips. Back then, tulips were a newly imported luxury item, and demand soared. People started trading them like commodities, and prices went absolutely crazy. Some rare tulip bulbs traded for more than the price of houses. It wasn't about the actual flower, it was about the belief that someone else would pay even more for it later. Of course, that couldn't last. The bubble burst in 1637, leaving many investors financially ruined. But Tulip Mania isn't an isolated event. History is littered with examples. The South Sea bubble in the early 18th century involved a British company promising huge profits from trade with South America. Investors piled in, driving up the company's stock price to astronomical levels. Sound familiar? It crashed spectacularly, wiping out fortunes. Then there was the railway mania in Britain during the 1840s, fueled by excitement about the potential of railroads. Again, inflated prices, overinvestment, and an eventual crash. Fast forward to the 20th and 21st centuries, and we see bubbles in the stock market. The Roaring Twenties saw a huge stock market boom, fueled by easy credit and speculation, culminating in the devastating crash of 1929. More recently, the dot-com bubble of the late 1990s saw internet companies with little to no profits skyrocket in value, only to come crashing down in the early 2000s. And of course, the housing bubble of the mid-2000s, which led to the 2008 financial crisis. So how do these bubbles form? It's a cycle. First, there's an innovation or a promising new market, like the internet in the 90s or housing in the 2000s. This creates excitement and attracts investors. Easy credit often plays a role, making it easier for people to borrow money and invest. As prices rise, more and more people jump on the bandwagon, fearing they'll miss out on the gains. This is that herd mentality. Let's illustrate with a simple example. Imagine a new collectible card game. Initially, a card pack costs $10. People start buying them thinking they're fun. A few rare cards are highly sought after. Let's say a legendary dragon card becomes incredibly popular. Because demand goes up, sellers start asking $20 for a pack, hoping to get that dragon card. People pay it because they believe the dragon card will be worth even more later and they can resell it for a profit. Soon, packs are selling for $50, then $100. This isn't because the cards themselves are worth more, it's because of speculation. Eventually, people realize the cards aren't actually worth that much. The demand dries up, prices plummet, and those who bought at the peak are left holding worthless cards. Why is understanding this relevant to the US audience today? Well, markets are constantly evolving and bubbles can form in unexpected places. We've seen speculative bubbles in things like cryptocurrency, meme stocks, and even certain sectors of the real estate market. Identifying the signs of a bubble, rapidly rising prices, excessive speculation, easy credit, and a disconnect from underlying fundamentals can help you protect your investments. It's not about predicting the future, it's about being aware of the risks. It's important to remember that bubbles don't last forever, they always burst. The timing is unpredictable, but the consequences can be severe. That's why it's crucial to invest wisely, diversify your portfolio, and avoid getting caught up in the hype. Don't invest more than you can afford to lose, and always do your research before making any investment decisions. To summarize, financial bubbles are periods of unsustainable price increases driven by speculation and herd mentality. They've happened throughout history, from Tulip Mania to the dot-com bubble, and they always end with a crash. Recognizing the signs of a bubble and investing responsibly are crucial for protecting your financial future. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.